Fed have signaled that they will be raising rates, but they've given little guidance as to when and by how much. No rate hikes this year. That's the call of my guest on GoldCore TV this week, Gary Savage of Smart Money Tracker. But will this cause a melt up in stocks before we see a massive correction? Whatever happens, buy physical silver. That's Gary's call. To find out why, watch this episode of GoldCore TV. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn how to buy, sell, or store physical gold or silver, log on to goldcore.com, your precious metals experts. Gary Savage, welcome to GoldCore TV.
Thanks for having me, Dave.
Now, we've had some comments out of the Fed, particularly just after the Jackson Hole. Powell is obviously alluding to the fact that there's going to be some tapering. We haven't really been given guidance on the extent of that tapering or the timing of it. What's your feeling around that? What are your charts saying that we could be vulnerable to if we see something a little bit out of the ordinary, either a bit faster or a greater extent of tightening?
I tend to doubt that they're going to do anything this year. They're certainly not going to raise rates anytime soon. So I think until they do, we're probably going to continue the parabolic rise in the stock market. And then I think once they do start to taper, the market's going to rebel and we'll have, depending on how high the parabolic move has gone, we could have a market crash, and then I think they'll have to reverse and start again. And at that point, I think it's going to be really good for commodities.
So you think we're going to see a melt-up scenario in stocks from here?
If you look at a really long-term chart, it's pretty clear we are probably in the latter stage of a bubble. I think they usually start with a big move in the opposite direction. I call it the slingshot. So March of last year, that was the slingshot, loading the slingshot. We had the big crash, and central banks started printing a lot of money, and we've gone straight up since then. My feeling was 15,000 on the NASDAQ was probably an important number, and once we broke out of that, I think we're going to start that the final phase of the melt up, and maybe we get to 20,000 fairly quickly. It could be in 3 to 4 months.
So a serious melt up and then followed by a correction. What's your feeling, or what are your charts suggesting with respect to the depth of that correction if we see something?
It all depends on how far it goes on the upside. It's I call it the rubber band theory, that the further you stretch it, the more violent and aggressive it goes back to the other side. So depending on how far above, let's say, the 200-day moving average price stretches, then the further it goes to the upside, then the further it's going to go to the downside. So right now, we're not too extreme. I think the last I looked, the NASDAQ was maybe 12% above the 200-day moving average. But at that top in 2000, I believe the NASDAQ was about 60% above the 200-day moving average. So I think we could see something similar this time.
And are your charts suggesting that NASDAQ is then probably a bit more vulnerable to that correction, as in it might start there, or S&P or the Dow? What's your feeling on that?
I think the bubble's going to be in the NASDAQ just like it was back in 2000, probably in the FANG stocks. They've kind of been leading this bull market the whole way, and Apple's just starting to break out. So I think that's where the bubble's going to be at. And that's where the biggest crash will probably be, I would think.
So initially, you think we see a rotation out of the technology stocks, possibly into utilities, or where do you see that happening? Or how do you see that happening?
I think what generally happens is when a bull market in stocks ends, then the liquidity flows into the commodity market. So what I think is probably going to happen is all the markets will go down, but I think the NASDAQ will probably get hit the worst because it's probably going to go the furthest to the upside. And then once the smoke kind of settles, I think central banks will start printing like crazy, trying to rescue things, and but I don't think the liquidity will some of it will go back into the stock market, but I don't think it's going to stop the ultimate collapse, and then the liquidity will start to flow more and more into commodities, kind of the same thing that happened after the 2000 top.
So at that stage, the writing's on the wall, and no matter how much money printing that we see, it's not gonna save stocks at that stage. So we see a correction in stocks and a roll out of stocks and into commodities. Do you see that as being a broad-based commodity rally, or do you think that it naturally should favor precious metals?
It'll be broad-based. I think precious metals will do very good during that period. Right now, metals are kind of stuck. I think as long as things are calm and the stock market's going up, then I think the powers that be try to keep metals kind of contained and suppressed. And as long as gold isn't going parabolic and going crazy, then the rest of the commodity markets tend to stay contained, somewhat contained. Although that hasn't worked. It worked pretty good over the last decade, but it has kind of stopped working since the March bottom. Oil and lumber and all of those things have kind of ignored the suppression of gold, and they're just kind of dancing to their own drummer now. So, they're going to try and keep gold contained, but I don't think it's going to stop the liquidity that's flowing into the commodities right now. And then again, when the stocks bubble pops, then I think we're going to have a lot of inflation in the years ahead.
Maybe you might just pull up a gold chart there for us, and we just have a look at some of the key levels that you're looking out for.
Coming out of the March low, this is kind of illustrates my point. When the powers that be have bigger problems, they kind of ignore gold and they just let it do what it's going to do. But once they get the stock market going up and things are going well, then they want to keep commodity inflation in check if at all possible. It's impossible to try and suppress all of the commodities, but you can try and suppress the canary in the coal mine, which I think is gold. And if you keep gold under wraps, then everything else kind of tends to more or less behave. Again, like I said, it hasn't been working great recently, but this was where coming out of the March low, central banks started printing a lot of money, pumping the stock market back up. It pumped the gold market up as well. Once they got everything back on track, then we start to see the suppression of the gold market again, and it's just been caught in this sideways to slightly downward churn. I do think we've got an intermediate bottom right here. I think this is an intermediate bottom. And one of the tools that I use is cycles, and one of the rules is that breakouts that occur early in a cycle tend to have sustained follow through, whereas breakouts that occur late in a cycle usually tend to fail.
Can you give us an example there on that chart?
The gold cycle runs about 25 weeks, something like that. So let's just use this as an example. We want to see, when is this? When is gold going to break out above these all-time highs, and also give us a sustained move? We need one of these intermediate rallies. So this is an intermediate rally. We need the intermediate rally to test this early in the cycle. So like I said, about 20 to 25 weeks is normal. That's measured from trough to trough. So here is an entire intermediate cycle. So if we were in order to get a sustained breakout above this, we need this intermediate cycle that's starting now to get up here and test this top pretty quickly, like say within 6 or 7 weeks. Well, we're already 3 weeks into this. So I think we're probably not going to do it on this intermediate cycle. I imagine gold's probably going to come up and test this 1960s level, and then I think they're going to, knock it back down. So I think it's going to take a little longer before we can get, a strong move, something that tests this early and we get a breakout. So probably next year.
And currently we're just sitting there at that moving average. What's that moving average you have on your chart?
That's the 200-day moving average. So I've discussed this with my subscribers as well. They tend to, it seems like lately anyway, they tend to attack the mining stocks as a way to try and keep the metals suppressed. The banks have gotten a lot of fines manipulating the metals, but there's no rule against shorting the mining stocks. So perfect example. And let me pull this up. So this is GDX. So we had the big pop on, I believe this was Friday. And then we started to get follow through on Monday morning. But they immediately started shorting the mining stocks right here. And that just killed the momentum immediately. And then yesterday, I think they covered those shorts. But it accomplished what they want to do. They don't want the metals to get a lot of momentum here. They don't want gold really starting to accelerate to the upside. They want the liquidity to stay in the stock market. Apparently, they're more than happy to create another bubble in stocks. So, this is just kind of well, for me anyway, I've kind of become disillusioned with the mining stocks. I'm just going to trade the metals, the silver and the gold. I like physical silver. Take it off the market. Take the supply off the market. It makes it even harder for them to continue to manipulate these things. But I think it's probably going to be next year before we really start to get some upward momentum in the gold sector.
And talking about silver, then maybe you might pull up a silver chart for us. You also made a comment there recently in relation to silver manipulation and saying that it was starting to fail. Maybe you might just explain your thinking behind that.
All right. So silver's been stuck in this sideways churn for over a year now, and the same principle applies. The top of this consolidation box is at about, let's call it $30. We need to get there early in an intermediate cycle. If we do, then we have a good chance of breaking out above 30. And when we do, we're going to go to 50. I suspect they're going to keep this under wraps during this intermediate cycle. And we're probably, we may get up here to 30, but I think it's going to be late in the cycle, maybe week 12 to week 15. And when you get there, with not much of the cycle left, the odds are not good that you're going to have that breakout. So, I won't give up on it yet. The employment report on Friday could be a trigger event for a big move, but we really need to get silver really needs to get like up above $26 here pretty quickly. This, by the end of next week, I would say, if it can do that, then maybe we have a shot of testing the upper boundary of this consolidation box early enough that we can get a breakout and get that run to 50. But I doubt it.
And that's the length of cycle in silver, similar to the cycle in gold?
It just follows gold. Gold is the cyclical driver for the precious metal sector. So when gold forms a bottom, silver usually does too. And silver usually tops, either the same day or within a day or two of gold.
So do you think that we see, going back to your thoughts on the Fed, do you think that we see a move in those metals while we see this melt up in stocks, or do you think that it's as a result of a rotation out of stocks after a melt up scenario?
I think we're going to get a rally here. Similar to what we had here, but again, like I said, you see it just chewed up a lot of time here and didn't really get to that $30 level early enough. So And I think as long as stocks are going parabolic, then people are just going to go where the easy money is. So we've got a rally coming, but I really doubt that we're going to, that this is going to be the intermediate rally where we can break out above $30 and make that run to 50. Again, I may be wrong, but I would say by next week we need to be, $26 if we're going to have any shot at that.
Okay, so you see a breakout in gold and silver, but more than likely not in this cycle anyway. And that if we see a sustained move higher early in a cycle, that's the thing that gives the strength and the impetus for it to break through some of those key resistance levels. Is that correct?
Correct, yeah. But I think that's probably going to be next year before we can get that early cycle breakout.
And is there anything in particular that you're watching or that has caught your eye across all asset classes at the moment?
I think one of of course, obviously the bubble in the stock market, but also, and we discussed this, I'm pretty sure we started a secular bull market in commodities back in March as well. Oil briefly traded at whatever it was, minus $30, minus $40 a barrel. If that's not the bottom of a bear market, I don't know what is. So once the stock market bubble pops, I think we'll enter a long-term bear market in stocks, and I think we have started a long-term bull market in commodities. So I think that's a major one, and I think people should keep that in mind as once the stock market bubble pops, that you probably want to switch your investment and focus more on commodities. But for right now, you might as well ride the bubble in the stock market. It's easy money.
And Gary, tell us a bit more about what it is that you do and the service that you offer.
So I do, usually I do several reports a day. Just when things catch my attention, I do a much longer report on the weekend, where I kind of aggregate everything that happened during the week and along with my expectations of what's to come. I'm mostly using cycles and sentiment as my tools to navigate these markets. Metals especially used to be really easy to navigate, but as we get more and more manipulation to keep the metal suppressed, they have become pretty difficult to time the moves in the metal. So my main recommendation, and this has been like for the last 6 months, I started beating the drum on this, is probably just buy as much physical silver as you can. You're trying to compete against the day-to-day manipulation. You're probably just not going to win that battle. So probably the only way to really win is just keep stocking up on physical silver, and at some point we're going to get a breakout here. We're going to go to 50, and then I think once we break out above 50, I think silver is going to go to anywhere from $250 to $500 before the bull market is over.
And where can people find out more about what it is you do? What's the website? It's
Smart Money Tracker Premium.com that's the premium site. If you want to just watch some of my free videos, that is a blog.smartmoneytracker.com, I believe. Or you can just Google Smart Money Tracker. It'll take you to the blog, and you can see the free videos, and you get an idea of what I do.
Okay. Well, what I'll do, Gary, is I'm going to put the links to your sites in the description and show notes for this video. So anybody that wants to have a look at what it is that you offer, just click on those links. But for now, Gary Savage, thank you for joining us today on GoldCore TV.
Oh, thanks for having me, Dave.
Thanks for watching. And if you enjoyed this video, you'll definitely enjoy this series of interviews with experts like Jim Rogers, David Brady, and David Garofalo, the ex-CEO of one of the world's largest gold mining companies. And remember, if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn how to buy, sell, and store precious metals, visit goldcore.com, your precious metals experts.